Great. Welcome, everybody. We'll get started in a few minutes. Let people filter in. Okay. Good afternoon, everybody. My name is Ali Javahari. I'm an analyst specializing in emerging technology at Pitchbook, and I'm very thrilled to welcome you to another edition of Pitchbook's Emerging Tech Talks. Today's session will focus on a critical and rapidly growing sector, defense tech. Specifically, we'll be exploring the late-stage venture capital ecosystem in defense tech, looking at key topics such as valuations, business models, and the impact of different kinds of government contracts on startup growth and success. We'll also take a closer look at the challenges and opportunities investors and startups face in this high stakes but highly bureaucratic and regulated environment. So before we begin, on our next slide, you'll see our esteemed panelists. We have David Rothsteed, a VP of Investments at Shield Capital. We have Chip Walter, a partner and managing director at Marlinspike. And we have Natasha Ahmed, who leads corporate development at Epirus. Today's event is brought to you by Pitchbook. We are the top provider of global financial data, research, and insights, and we are committed to providing the most comprehensive market data available so our clients can stay ahead of industry trends. So for those interested in learning more about defense tech, we have a series of reports, including our most recent defense tech report published in summer of 2024. We also have a space tech report that was published in 2023, due for a revamp next year. And we have smaller market briefs on various defense technologies, one of the most recent being one on counter-unmanned aerial systems. And just as a further plug, we will actually be launching private equity coverage of aerospace and defense in the coming months, led by our analyst, Jim Corder. So before we kind of get into the data, just to set the stage, how Pitchbook defines defense tech is in very broad terms. It is in the context of the 14 critical technology areas identified by the US DoD. And these range from AI to autonomous systems, advanced materials, cybersecurity, even renewables, and biotechnology. But if we look at this framing of defense tech, we see that in terms of late-stage defense activity, it's hovered around 40 to 60 billion each quarter after a notable spike in Q1 of 2023. Now, if we drill down on the next slide, you'll see that we have a significant amount of investment in autonomous systems over the last 12 months, with 4.7 billion invested across 47 deals. This category includes UAVs, unmanned ground and surface vehicles, counter-UAV systems, and defense and system integration, so sensor fusion companies like Anduril, Picogrid, etc. Now, if we drill further down into autonomous systems, we see that the quarterly late-stage VC activity in this space is increasing in momentum over the last few quarters, signaling growing interest. And this aligns with the DoD's Replicator initiative, which is to field multitude of autonomous and attributable systems. So as we move into our panel discussion, I'd just like to remind everybody that the session is being recorded, and we will send you an email of the slides and the recording after the event. We'll also have a Q&A at the end, so feel free to save your questions for that part of the discussion. So before we get into questions, I'd like to let the panelists themselves introduce themselves and tell us more about the work they do. So, Natasha, if you could start us off.
Hey everyone, thanks for joining. I am Natasha. I lead corporate development for Epirus. It is in the strategy function, so it's a really important role, especially for us as a late stage company. We are a non-traditional defense tech company. We are the world's first software-defined, solid-state, GAN-based electronic warfare platform. I'll dig into this later as we go throughout the conversation. You may know us from our focus on counter swarms, and we see that mission critical need right now playing out in current events. So I'm excited to dig in with the other panelists. Thanks for having me, Ollie.
Yeah, sure. Chip, go ahead.
Sure. Thanks, Ali, and thanks for allowing the opportunity to participate today. Read your reports, all really insightful, really enjoyed them. The DefenseTech, rather long, which always tells me that you put a lot of thought into it, which is exciting, and the charts, and particularly the VC activity, the way you have it broken out, really, really helpful. I would say it's more confirmatory than saying, oh my gosh. So, because this is where we spend all our time. Marlinspike is a dual use fund. I would tell you, all weather, we'll do early, we'll do mid stage, and we'll do late. Not most recently, last year we invested in annual. So we're not afraid to go late, and we pride ourselves in the work we do after the investment. Very similar to the areas of which you focus on, we focus on 4 primary verticals: aerospace, autonomy, AI, and cyber. And we try to, if you will, spread throughout that. We agree that autonomy is probably the hottest one right now. We're seeing the same thing in that it reflects some of our recent investments. We'll just say that if I could say it like that. With that, I'll just 2 seconds about me. 20 years in the Navy, P3 pilot, Major Command, started out the Naval Academy. After that, I did a lot of stuff with General Petraeus in the legislative side. After he retired, I retired. He went to CIA. I went to CIA with him. He left CIA for KKR. I stayed in CIA and went down and ran an innovation center down in Science and Technology Directorate. That's interesting because that innovation center is mapped directly to In-Q-Tel. So for 5.5 years, I ran that innovation center, so it was pretty cool. After that, dropped my resume. I was picked up by Northrop Grumman. So I got to see the other side of it, if you will. I don't want to say the dark side, because actually I think the primes are key to this process. But I was there for about 3 years. And after that, I kept on running into Neil Keegan and Mislav Talusik. And when they started the firm in 22, after 2 years of investing in SPVs in the same space, I just wanted to join. I think we're off to something. And I think, to your point, I think this defense dual use kind of arena is hot, and it's hot for a good reason. So I'll stop there. Thank you. And thanks again.
Great. Thanks, Chip. David.
Thank you, Ollie, and great to be on this panel with Natasha and Chip. Really excited about the subject material we're going to cover. So I work at Shield Capital, and we're an early stage investor. We focus on 4 technology domains: autonomy, artificial intelligence, cybersecurity, and space. And yes, I think colloquially we do operate in this dual use technology area. We raised our first fund at 186 million and are currently deploying out of our second fund. We like to lead the early stage rounds and take active participation with our startups and kind of help them understand and penetrate the DoD market. And a lot of that is predicated on our collective team's background. And so for me personally, prior to joining Shield, I spent over a dozen years in the Department of the Air Force as an acquisition officer, which is just kind of like a fancy way of saying a businessman. So working with the primes. But then I also spent 3 years Defense Innovation Unit from 2016 to 2019. And I personally believe that DIU has a lot to do with why we're at a little bit of this inflection point and changing the culture around defense procurement trends and working with venture-backed startups who once upon a time, not that they shunned the DoD, but they were just kind of ignorant on whether or not they could be a good potential customer. And obviously with the advent of the war in Ukraine and then what's occurring in the Middle East, we're seeing how technology that isn't necessarily super sophisticated or maybe not being developed in government labs is now having a major impact on the way wars are being fought. And so this is a pretty compelling time to be having this discussion. So thank you, Ali and Pitchbook, for your all's leadership and helping sort of bring more awareness to this market.
Of course, and I really appreciate those comments, and I appreciate you all being here. I'm sure this is going to be an insightful discussion. So just to get into it, Natasha, this is a question that's more pertinent to you, but as Epirus is a later stage company, right? And as that transition from early to late stage it goes on, what are the key challenges in this transition, and really how does this relationship between startups and investors evolve during the process?
Yeah, that's a great question. A little bit about my background. I was an investor prior to coming over to Epirus. So I've been a late stage investor. I know what investors are looking for. I would say that the relationship change is really important, both from an investor side and also from a company side. I'll speak to the Epirus perspective. Early stage companies are really focused on technological maturity, and those investors are really looking for your technology readiness, TRL level maturation. Epirus is at the stage right now where we've de-risked our technology. We are at a late TRL. We have transitioned that product already. So we really have found product market fit. So as you evolve and you grow up, it's similar to a toddler evolving and growing up. You need different types of resources and different types of investors. We prioritize the investors that really understand this market. That means understanding what the GoCo contract model looks like, right? Who understands how it is to be a commercial and a defense company all in one, the dual use model. The resources that we require right now are investors and partners who are going to help us take this company public. That is what we are focused on. So that relationship change is really important to us. So as we now focus on late stage investors, one of the most important aspects of this capital is patient capital. We understand the nature of the business. We're really focused on the mission. And so investors in this late stage arena need to also understand the horizon. We know the market is ripe, and we know we are one of the key players. As a unicorn, we have a responsibility for the ecosystem. So we want the investors that are in with us to understand the return aspect and also be patient capital as we grow the company and we expand. I think in addition to the investor front as well, one of our big challenges as we focus on execution has always been kind of helping push the acquisitions system. As you know, any company that is working within the DoD acquisitions process is subject to a timeline that is in flux continuously. A lot of that is the push and pull between DoD and Congress. And so one thing that I would always say, especially before an election year, is acquisitions process and the PPBE reform is incredibly important for us, especially because we do think we are on the front end of this innovation that's happening on the battlefield. The risks that you're seeing, the electrified battlefield you're seeing right now in the Middle East and Ukraine is not far away from what is going to happen in Indo-Pacific. So acquisitions is always going to be one of those key challenges, the timing of those acquisitions. On the investor side, investors understanding what that means for the business and how that reflects in recognition of revenue and potential for the company. So really for them to dig in and understand why it is so incredible that we found product market fit within arguably the hardest branch of all, Army, and why that means our market potential is incredibly large. Those are investors that would understand this market and the acquisitions process very well.
Yeah, makes sense. I mean, Chip, David, do you have any thoughts on this transition from early to late stage as on the investor side, and David even on the acquisition side?
Sure, I'll go. I'll start it off. So I agree with Natasha, a lot of the stuff that she mentioned. I think when we look at late stage, we are very cautious and conscious of whether it's a hardware or software company. Each one has a little bit different flavor to them. The key thing there, as you're talking, Natasha has taken down some furious notes on where I thought that we could add here to the conversation, and that is the technical risk. You're exactly right. By the time you get to the later stage, that's got to be burnt down. If it's not burnt down, it's going to evolve in a conversation, and it's probably going to slow some stuff out. So the burning down of technical risk is important. One of the things that we really focus on is revenue build and execution performance. So as you get into the later stage, you're starting to look at, okay, in the beginning stages, early and maybe early mid stage, there's a couple leap of faith you have to take. Okay, the company's team is good. Okay, they can do it. They can execute. Their pipeline looks good. Their revenue forecasts look good. Yeah, they're all up and to the right. They all are. All that stuff is pretty typical. And a lot of times in the earlier time, you're betting on the team. Well, when you get to late, it's the evolution of that team of executing on what you thought was going to happen when they were early. So that execution performance and that building revenue is something that we're going to watch and we're going to look at very carefully. I think the idea of patient capital is important, because if you're in the defense world, as Natasha said, we can get into it later about the 5-year defense plan, all that other stuff. But the point of it is that this stuff in the military doesn't happen overnight. And you have to be patient as the defense acquisition process spins and spirals to actually make that revenue real on the, and sticky, as they always like to say about the government. And then lastly, I would just say about a late stage is that we also want to start seeing that move, if it makes sense, into the commercial side. It doesn't matter where you start. You can start in commercial and then go into defense. You can start in defense and go into commercial. But at the end of the day, we're going to want to see some defense traction and some look towards the commercial side as a potential. At least they're considering it as they go forward. Thank you.
Yeah, thanks.
Yeah, good. I mean, way to start us off, Natasha, and great comments, Chip. I think something for the listeners on the panel to recognize about the Department of Defense, if you don't already, is that the DoD is not a monolithic buyer, right? It's a very fractured entity, right? Obviously, you've got the individual military branches, right? Marine Corps, Space Force, Air Force, so on and so forth. They all have their procurement culture and the way that they buy things. But then even within the individual branches themselves, the various commands, right? So on the Navy side, you've got the aircraft side, you've got the submersible side, you've got the surface warfare side, right? Again, very different models for the way that they like to procure capability. And then, the other element that's, unique about the DoD is with the fact that you're not just dealing with one customer interface who can make the ultimate decision about buying or not buying, is what is the type of capability that you're selling. If it's a system that the DoD is going to be owning and operating, then it's got to come with, its own training and manual, which means it has to be implemented into its doctrine and its operations, which takes a long time to stand up. There's a little fancy acronym called .NLPF that the DoD uses in order to make sure that when they buy these major material purchases, that they've thought about everything. But of course, it takes a long time to sort of weave that through the process, versus if you're just selling software, maybe you can team up with a value-added reseller. One that does come to mind would be like a Carasoft. They're on any number of different contract vehicles, whether they're the GSA schedule or NASA SOUP, right? And they could actually be your business development arm if you're already starting to see some traction and have something that is meaningful. And so I think it's really important as an entrepreneur or even as an investor that you are broadening your understanding of the different methods by which the government buys. And not everybody needs to become a program of record, though in certain instances, you absolutely have to become a program of record, which means you got to be working your stakeholders on Capitol Hill, which means you got to be working stakeholders at the Pentagon, in addition to the operational components out in the field, whether that's Indo-PACOM, as Natasha mentioned, or other regional commands or functional commands. Again, it's kind of an organizational acronym soup. best of luck if you're unwitting to it. But if those of you that are in the know, just remember, you can never have too many stakeholders that are trying to push for your technology. So I'll stop there and get into some more of these juicy questions that Ollie has set up for us.
Yeah, and David, you said, oh, sorry, Natasha, were you going to say something?
I was just going to add a real quick comment to what David mentioned with doctrine. For me, doctrine, and for our company, it means thesis. And when we were incorporated and we started, we really had to showcase why swarms were going to be a threat. This was very early when this happened. And so we took a huge risk to focus on understanding the electrified battlefield and what it means, what a swarm means. And we have made those inroads. And so I would say to other late stage companies, that is the thesis, that is the doctrine shift you really need to focus on. So to your point, it's really important to have that message.
Yeah, Ali, if I could I want to just double tap on one thing that I thought David brought up really eloquently about, not about .mlpf, but the acquisition process and how it can be different amongst everything. A lot of times when you're talking to early and mid-stage companies, they look at SIBRs, they look at StratFis, they look at TACFis, they look at, OTAs, and those are all exciting and they're interesting, and each one has a different flavor, each one has a different characteristic to them. I think David was right, and I don't know if Natasha mentioned DIU as well, but DIU is a beast. They are beasts. They're funded like a beast now. OTAs are really good. They're not like a SIBR. So you have to know that difference. But at the end of the day, those are not program of records. Just to set, and the earlier you are in the SIBR, the more it's a sugar pill. The later you are, the better it is. OTAs are best. So there are ways to really think about this in my mind. And it's evolving every day. It's, I don't want to say the purpose of it's is not changing, but how people reflect those on whether it's revenue or not revenue, it's something to be considered as you're looking through as these companies mature. Over.
Yeah, definitely seems critical. And David, I mean, this point that you brought up of, there are all these different entities within the DoD that have different sort of approaches to acquiring new technology. I mean, how does this actually affect the sort of decision on the basis on the part of a startup on whether to pursue sort of defense only versus like a dual use business model? I mean, what are the different routes of success for a defense tech company? And then how does this play toward dual use versus defense only kind of factor in terms of scalability and even long-term viability?
Sure. Yeah, so I think for pure defense tech play, you definitely want to leverage all of the different pathways and avenues that the DoD provides to help, offload some of the research and development cost to the degree that you can, right? Because, your investors certainly are going to be coming in with deep pockets, and they're going to hopefully not come into this unwitting about what it's going to take in order to build a proof of concept and something that can be exercised and trained with. And there are lots of good avenues for that. I think for the dual use technology companies are the ones that have, other markets outside of the DoD and the national security apparatus. For us at Shield Capital, the way we think about it is who's going to be a good first customer to be able to provide you the requisite feedback as well as some of that early stage funding that will allow you the runway to sort of engage with other markets. So, this is a generality, but it kind of holds true. If you're an artificial intelligence company, right, you're building an AI application or you're a AI infrastructure type play, I think, getting a SIBR maybe could be helpful, dipping your toes, learning about the needs, getting involved with a couple stakeholders. But as far as gaining real revenue traction in the way that me as a VC, knowing that you need to raise another round and show promise and capability, you're probably better off focusing on a different commercial industry. Obviously, there are other regulated areas like healthcare and finance that can be just as challenging as the DoD, but ultimately you should think about the DoD as a good first customer if in fact there's a fairly robust market there and that you need it as a proof point in order to then sell into the commercial market. So a good example of this would be, I think, for the space sector, right? No one has a more insatiable appetite for remote sensing capabilities than the intelligence community and, of course, the United States Space Force. There's certainly lots of buyers on the commercial side, but not nearly at the same type of volume as you would see for national security. So the way that we sort of approach our technology companies there is, hey, focus on the DoD, and then over time you're going to be able to start selling into the commercial markets. So I think it really does depend on what type of technology you're building, where are the market opportunities, and then thinking thoughtfully about how can the DoD maybe subsidize some of your R&D spend to getting to first proof of point and concept. Thanks.
Yeah, thank you. That makes sense. I mean, Chip, what are your thoughts on that?
No, I think that's right. I think for us at the end of the day at Marlinspike, we're going to focus on defense only has for us a little bit of risk inherently because the market is limited in terms of the end all multiple you're going to have in the opportunity to IPO or the opportunity to be acquired. The acquisition, I mean, the primes are trading at 2x. So, they're not going to pay arm and a leg for, a defense only kind of company. IPOs are hard in the defense side. I mean, Andrew, hopefully, we're investors. Hopefully they'll be able to push the button, but it's not necessarily all that easy to IPO. I mean, Palantir is an interesting one. Started with defense. I was over in Afghanistan when they were over there doing everything they were helping us with. It was fantastic. But if you look at it now, they're now mostly commercial. I think it's actually 60-40. It went from 40-60 to 50-50 to, now they're really, nailing it on the commercial side. So we like that from, the investment perspective. But there, again, I think it depends on what you go to first and what that technology, where you can get some traction, early success. I would say almost prove your process and your ability to execute and build in revenue. All that's important as you transition through the stages from early to late. The later, as I mentioned before, I can't emphasize enough. You can have all the patents in the world, totally get it. You can have all the trade, all that stuff is great. But if you can't execute, that's what the investors are going to be looking for. So.
Yeah, and I'll
Tasha.
as well. I think even at the late stage, you are continuously looking at your TAM and looking at expansion, right? You have to be looking at the use cases and developing new use cases as you build momentum within the areas where you have product market fit. And that is something Epirus is continuously doing. So originally, we focused on the counter-SOAR mission, which we think is evolving, and we think now is the time to deploy this technology. And you will be seeing a lot of information on the news about that. But as we look at other use cases, we have a significant commercial side of our business, which is focused on the underlying solid state GaN amplifier and particularly energy and power optimization. So even at the late stage, you are continuously looking for use cases and how to build that out. I will just add, like with dual use, I think any and every company could be dual use. And like Chip and David mentioned, it could be at various stages of your life cycle. We particularly do think there's an area of opportunity to disrupt the primes. And that's not saying that we would not work with the primes, but we do think that there is less of an incentive because of the structure of their contracts and their relationships to capitalize and innovate from within. And so we do think there's a push and pull. Us being a new, defense tech, late stage defense tech company that's unicorn, we are trying to push and change those ways of thinking. We're creating an entirely new business model in and of ourselves, right? There are no real public comps, and that's what I think you'll see. And one thing that I'm curious to see, especially from a DoD and congressional angle, is how AI regulation will impact how we consider dual use, right? Right now, that technology is purely commercial. As those use cases develop and you see every single defense tech company is thinking about autonomy and AI. And so as you see regulation come down, how would that change the market opportunities? How will we be impacted by ITAR? These are things we continuously need to have a seat at the table at within those conversations, especially because, at least from Epirus's perspective, we really want to focus on and helping the US, especially with allied partnerships. You're going to need partners to deploy this technology as well for it to be as effective. So I'll stop there.
Great, thanks, Tasha. And you actually brought up an important point, the structure of these contracts and kind of how the primes are typically known for, the cost plus fixed fee structure, but we seem to see a push towards the firm fixed price. So my question for the panelists is, and David, you can start us off, is how does this impact kind of the valuation of defense tech startups, and how do you see kind of these non-traditional funding sources playing a role in kind of attracting further late stage capital as well?
Yeah, thanks, Ollie. So there is policy out there that will say, like, hey, if your contract is going to be over this amount of funding, it must be cost plus, and then either incentive fee or fixed fee or award fee, right? Lots of different elements on the back end. But essentially what it does is it caps the available amount of profits that you can capture as a company. It also, if you're a dual use tech firm, you would have two separate accounting systems, right? You would have your generally accepted accounting principles GAAP, right, which is the industry standard. And then you'd have this other thing, and you'd have to account for all of your labor costs, your overhead, your G&A. And, essentially what it comes down to is if you're building a piece of software, and the beauty of software, the reason why VCs like Chip and I and Natasha at one point loved investing in those types of companies is zero marginal cost for shipping the product once you've built it. But obviously a ton of R&D and a ton of sweat equity, what have you, to build in the first place. But on the DoD side, you can't necessarily just get the same level of profitability on a cost plus whatever fee structure. You would have to figure out how do you account for the labor that goes into the maintenance and the upkeep of it. So, I think it's very much incongruent with the investor and how they want the business to scale and drive down the marginal cost of their cost of goods sold over time and increase their revenue streams. And, it's not necessarily, it's not how the DoD has traditionally acquired. And a lot of it has to do with, how the regulatory environment sprang up in, the 1940s and beyond, that these are the types of companies, they're mostly hardware companies, building capability that we're going to use before anybody else uses, right? And so dual use used to mean built in the government, spilled over into the commercial, and now it's kind of taken the opposite course. But the business models, and it took commercial a long time to be able to understand and figure out SaaS. The DoD has not quite made it that far. So, really what we need to be doing is pushing on policymakers and congressional members to ensure that firm fixed price type contracts or time and material like contracts become the norm, especially for the types of companies that Chip and I are going to be investing in, because otherwise they won't be able to return the same type of profits that would have enticed me to invest in them in the first place, right? So if you take away the incentive, the opportunity cost is they don't exist. And I do think that this is a bit paramount in the overall discussion around defense tech, dual use, et cetera.
Yeah, for sure. I mean, Chip, what are your thoughts on that?
Again, just to make the firm fixed price, and we're talking about, David mentioned the size of a contract. Think about building a carrier on a firm fixed price contract. How do you do that? I mean, it takes 6-8 years to 7-8 years to build these things. Inflation alone can, totally blow everything out of the water. Forget about, some technical risks that you think you've burnt down and you find out it's not. So, there has to be some opportunity for, the bigger, and there is, obviously, there's regulations out there, or policy out there in order to do that. But there's also, I think there's some interesting inflection points on when you go from cost plus and when you go to firm fixed price. So Anduril's slaying it. There's no doubt they're slaying it. They're firm fixed price. They got it. But that also has to do with the way they're executing. They are executing like no other company right now. They are carving out these little sleeves of wins. You saw on the CCA, they won over Lockheed, Boeing, and my old company Northrop Grumman. I mean, they were just slaying it. Who would have thought that you could build a submarine and then deliver it 3 months early to a foreign country? That's kind of rare by any stretch. It's also rare to have a billionaire as your founder. So there is some things that go into that to, make them a little bit different, but their execution is flawless, and that's the key to that. I do think we have to be a little bit careful in the earlier stages of throwing companies into firm fixed price right away. Uh, Not that, it's a one size fit all, but when there's some R&D still going on and there's still some technical stuff they're burning through, firm fixed price can be very difficult for a company to be able to actually navigate the contractual process with agility and speed. So, there's a balance here, but I do agree with David that, like a cost plus is, there's a hurdle rate that they're going to go for, however you want to, 12% or whatever it's going to be. That's not what the venture is looking for. We want to see those, we want to see the company perform and execute on firm fixed price and just crush it. So, I mean, I'll stop there, but I think that there's a balance with this firm fixed price and cost plus. And I think a lot of that is going to be in the maturity of the technology and how big it is and stuff like that. So I would hate like heck to say everything's firm fixed price. And I'd hate to say everything is cost plus. So I think that we have to be smart about this, and each contract can be different. We just have to be, I would say we have to be responsible to the customer, which is DoD, and the taxpayer as well. And if we're responsible in that layer, I think we're going to find the right balance.
Yeah, thanks, Chip. Natasha, I mean, what are your thoughts from the startup perspective?
Yeah, so I will take it back just really quickly before we even go to contract types. Like I mentioned earlier, business models are going to be different, right? DoD does not yet know how to buy and procure software in mass. So while investors really love SaaS in deep tech, I will say the revolution right now is the modernization of our platforms. This is where we as a company and other startups like us see the biggest need is software-enabled hardware, particularly new, more agile, unmanned, autonomous systems that are really helping protect the warfighter, which is kind of exactly where Epirus is focused on. To Chip's point, companies can survive in many ways, right? When we say patient capital, if you have a billionaire founder, you have built-in patient capital, right? SpaceX is the prime example of that. And look at how many inroads they've been able to accomplish at the almost brink of failure and then the final successful orbit. And now, they're one of the highest valued private companies on the market right now in this defense tech world. So I would say SpaceX is a great example. Another thing I would say is I think DoD really needs to understand incentives and structures. They want and need this new technology, and they want to field it. There's a clear need to field it. They do not yet know how to do that in a quick timeline, and this is where the contract types come into place, whether it's firm fixed price or cost plus. Clearly, like the primes prefer the latter because again, they have an in with the customer. They're not incentivized to really work on RD&E, RDT&E. And so because of that, we do see an increasing need for DoD to expand. This is where OTAs come into place. But I think for companies like us, we want more options, and we want options that are commercial minded as well from the DoD.
Great, thank you, Natasha. So everybody in this panel, right, they have a wealth of experience specifically in defense. But as we see kind of defense tech become a more buzzy topic, we have generalist VCs expressing a lot of interest, and navigating that defense ecosystem is difficult, right? So as generalist VC funds approach defense tech investing compared to the specialized funds, I mean, what unique challenges or opportunities are arising when generalist investors enter the space, both from a startup perspective and as kind of a partner investor perspective? Natasha, what are your thoughts?
Yeah, so I think it's really important, especially for late stage companies, to be able to tell the correct story to the generalist VC We love to see the expansion of capital flowing into this arena. It's very needed, and different investors have different risk types, structures, capital structures as well. And so we want to bring funding into this ecosystem. We think there are returns that exist. It is about telling the correct story to the right investor, and it's really helping them understand how this company, like others, cooperates in this whole ecosystem. So for me, I think it's always great that generalist funds are coming in, not just VC, but especially private equity that's flowing in. I worked for a private equity fund. They have various different structures. It's really important as a company when you're looking at those sources of capital to understand what the expectations are from you as a company. This is where I think there's a huge mismatch, and I will say there is a huge demand for this late stage funding that I don't see exists right now.
Chip, David, any thoughts there?
Actually, I have a lot of thoughts on
Go
this
ahead.
one. You know, it's so funny. But I think so first off, I love the term, Natasha, expansion of capital. I wrote that down. I think that's perfect, and I think it's important. And I think getting money in here, I'm going to say I love to use the word responsible money in here because I think it's important to say. I almost say it like that. Generalist funds at a late stage when they're dropping $50 million, go for it. Go. Reckless abandon, go. Find your company you want to invest in and go. I have some challenges, and I want to be careful here because I'm not trying to cast shade on any individual, because each fund, each deal, each construct, it's all different. But there is a little bit of concern with me when the generalist funds get into earlier rounds and they take down the round, they raise the valuation, and they push out the smaller specialist funds. Marlinspike is a specialist fund. It's all we do is dual use technology, and we focus heavily. Just like David does, we know the market really well. We know what it can do. We know where you can get these companies traction. We know at the end, I would say we are thoughtful on where we think these companies can grow and where they can do best. And if you bump up these valuations too much by coming in with a big check at an early stage, yeah, I get that money's always great for a founder. I do get that. And the more money, more operational flexibility, the more they can maybe accelerate, pivot, and do some other things. And the team really matters. Their maturity of the team really matters. But there's a piece of me that says, in the very early stages, there can be some damage done when a large generalist fund comes in and then takes down the round, and the company, after they get in there, they find out that they're not as attuned to the defense market as maybe some of the smaller specialist funds out there. So I do worry about that a little bit. I think it will resolve over time on where this makes the most sense. But that would be my it's a double-edged sword, I think, depending on where it is and what you're doing and the company that you're dealing with. If there's a company that is a hardware that takes a lot of CapEx and need additional funds, that's great. But just allow the specialist to get in there and do what specialist funds do well.
Makes total sense, David.
Yeah, I think for any entrepreneur out there, capital is certainly one part of the equation when you're raising. But I think, especially at the early stages, more important is, who's your partner going to be and how are they going to help you navigate? What kind of network are they bringing and understanding? I wouldn't invest in a healthcare company because I wouldn't be very useful there, even if I had a boatload of money, which I don't, right? So don't hit me up for your healthcare startup. I think though, one thing we as an industry need to be fairly mindful of, and I live here in Washington, D.C., which is where a lot of the power and Department of Defense resides. This is a political town, and perceptions really do matter. And so when a startup raises a big splashy round and then it doesn't really materialize, unlike in other parts of the innovative ecosystem, it kind of gets held against the entire class of companies, right? I just remember my time at Defense Innovation Unit, like, hey, we're working with venture-backed startups, and you try to relay that to people in Washington, D.C., and the example that they come back to is Solyndra. Maybe a lot of the people on the panel are not young enough or don't remember, right? Because there's too many world events happening. But Solyndra famously imploded after receiving a ton of, I think, 535 million in loans from the Department of Energy, and they were a startup, and the technology wasn't real. And that's what a startup is, right? Is Solyndra. So it is different. And so I think to my friends, my fellow investor friends who are not as witting and understanding of the overall defense ecosystem, when they bid up an early stage startup with too high of a valuation and put unrealistic expectations on their ability to grow, they may be actually screwing the pooch for everybody else from a perception standpoint, which I think is harmful. And I would love for them to more sit back, wait and see, and then deploy their capital at a later stage once that startup has sort of emerged and clearly become a bit of a winner inside the DoD, right? Through contracts, through technology demonstrations, and then come in with your big money at that point. But, I got to hand it to some of the, what I would consider generalist funds who have spent a lot of time and energy in building out a team to try to understand this marketplace and then, put their money where their mouth is and say that they're passionate about national security. I think, we want more people in the tent than less people, but for the founders out there, I would just say, and I know maybe it's a little bit biased, or you might even think I'm a little bit cynical, but I think whose money you're bringing in is almost more important than how much money. Thanks.
Yeah,
Thank you.
Ali,
Go ahead.
Tap on that, because I think that's a really good point. At the end of the day, when you start walking through these rounds, whether it's seed, A, B, whatever, as you go on, the calculation that I think every VC looks at is going to be your revenue to valuation. How much you're bringing in, what is your, what are you being valued at? And when you have something that is 10, 15, 20, 25, I mean, people can wrap their heads around it. If you're sitting around, 500, 1,000, infinite, where you're a very, very, the valuation's pumped up and you're just starting to get into the contractual world and actually have revenues, that dog comes back to hunt later on. Now, I'm not going to say that it puts a company, it just puts more pressure on the company, I think, because they're going to have more money. They're going to be able to accelerate. They're going to be able to do a lot more than with a smaller round. But the performance and the ability and the technical burn down and all that stuff that happens and the product market fit that Natasha's brought up several times, all that stuff matters. And in the earlier stage, I mean, it's still being worked out. I mean, reasonably, it's still being worked out. It's not set in stone. There's going to be pivots. A couple of our companies, rightly so, we picked them because of the team at the earlier stage. And that team has pivoted to the right place on where we thought they were going to end up, or where the founders, because we knew the team and how strong they were, that they would end up in the right place. So I think Natasha's and to David's point, there's a depends on all this, and more money is better in this market. Responsible, deployment of that at both the founder receiving it and the fund deploying it. I think it will just make the ecosystem stronger at the end of the day.
Yeah. Yeah, that makes sense. And I'm thinking, as we're talking about the generalist funds coming in, I mean, they obviously have a return that they need to make, and if they're a VC, they need to make outsized returns. So this question of kind of late stage companies preparing for exits, how do you see that going along? Are they going to go for acquisitions or IPO, and what should they prioritize to maximize exit value? Chip, I'll let you start off.
Take the first whack at it. I think, again, this is it depends. A lot of it depends on whether you're hardware, software, where you are, what market is there, commercial applications or not commercial. There's a lot of variables in that. What I would say if you take a look at all the acquisitions that's going on and your report has a good list of them, there's not 1,000 of them. I mean,
Right.
and how many IPOs have been in the defense market? You tell me. You got the research. I mean, not a lot, if
No.
any, right? Yeah, in a long time. I mean, at Northrop, I sat right next to the guy who did the M&A piece of it. They're busy all day long. It just does. The closing of it doesn't happen as frequently as I think people might think. They say, "Oh, I'm in defense. I'm going to get acquired by the prime." Okay, good luck with that. Let's see how that works. So, that's one of the reasons why we like to dual use first defense only, unless obviously you're an Andrel and you can really move out at speed and take down the world, if you will. But I do think that you have to, when it comes down to it, I've harped on it a couple times. So I go back to it. My last time, I'll double tap on it or triple tap on it. It's execution, and it's the generation of revenues through contracts and real things going on. There was a comment made, I think it was either by Natasha or David, I don't know who it was, but it was right on. If you can get into an exercise and show your value to that customer, and then you can double down with a contract and end up getting, as those contract values go up, and knock wood, hopefully all the founders hope it works for you, you get on a program of record, the more revenue you have, the better off you're going to be. You just can't have 50 million in revenue and decide I'm going to SPAC and I'm going to be somebody. So it doesn't work that way. Nobody's done that successfully, really. And take a look at the graveyard in the SPAC world that came about 2 or 3 years ago. So I would just think about that as you're going. Don't rush it. Let time allow your team to mature. I mean, there's a whole bunch, before you file your S1 and before you get going on that you really have to have your processes down. You have to have trimmed your spend. You had to maximize your revenue. All those things that go on, because as soon as you trip that trigger and you're public, guess what? If you IPO, the quarterly report's a different thing than, a quarterly letter to your investors. Analysts will be, driving, pain for your CFO as that goes on. So, I mean, I've talked enough on this. I think it depends, but I think you have to be smart, patient, and in our world, I think most is going to happen through M&A, vice IPO, but we'll see.
Yeah, if I can chime in there, Ollie.
Yeah,
This
go ahead.
to me, when I was an investor, um, my biggest, I guess, idea was it is a national security risk to not have more defense tech public companies. Not only because of the general societal value that public companies provide, but if more and more defense tech companies continue to remain private, what does that mean economically for the United States of America? And so for me, I will say as a national security investor, it's really important that we create an environment for defense tech companies to flourish and become public. Because when you become public, not only is there more increased accountability to the general public, but also you get access to the capital to be able to provide and scale the way to minimize your marginal costs, the way that the public companies have done. For example, I'll give an example too, Palantir. At the time when Palantir went public, if you looked at the revenues versus now, you would see a stark difference. I would say, yes, it's great. They went public at a time that it was economically viable to go public. The market conditions were very different than the market conditions we are in right now. I am starting to see the optimism and the shift and the change right now. Your chart initially that showed defense tech activity rising, the fact that there is a lot of need not only to consolidate, but also a lot of well-funded companies that are gaining tons of momentum that have a straight path to IPO. I think you'll see this change a lot. So yeah, back to the Palantir example. Palantir's, if you look at their public reports now, they are doing excellent. It does not mean that it can't be done. And it does not mean that there is no opportunity for IPOs within the defense tech world. I would say absolutely there are, given the dire need for modernization in the DoD and the new business model of software-enabled autonomous hardware platforms. There is a huge need, national security need for new IPOs in this world.
Great. Thank you, Natasha. David, any thoughts?
I mean, I think they're more expert than I am in this area, right? I'm an early stage investor. Prior to that, spent my entire career inside the Air Force. I'll just say that as an investor, I am hoping for more exits, and that people do really well, because then that money gets recycled back to the limited partners, who then reinvest in the VCs, who then invest back into the startups, right? Keep the velocity of innovation going. But without exits, the rest of the cogs in the wheel sort of fall apart. So I'll just stop there.
Exactly. That's right. Thank you. Well, I don't think we're gonna get time for questions, but I really, really do appreciate our panelists for the excellent discussion. It's very invaluable insights, and I'm sure the audience got a lot out of it as well. So really thank you guys so much for taking time out of the day to be here. And to the audience, thank you for participating. I did see some kind of Q&A and back and forth in the chat. We love to see that. So just as a reminder, this session was recorded. We'll be sending out the recording in the next few days, along with the slide deck. Please check out our reports. Please check out our panelists' work websites, and reach out to any of us on LinkedIn. And really, let's keep this ecosystem going, because as we kind of see in the world today, it is as critical as ever. So again, thank you, everybody, and we really look forward to seeing you at the next Tech Talk. Ciao. Bye-bye.